So the top thing that investors are talking to me about is two issues that are inexorably tied together, and they're one. One is what's going on in the capital markets, what's the cost of debt, who's lending, and what are those terms going to look like? In turn, that's tied to what's my property worth? Where's the value in today for this asset? What's the cap rate? Who are the buyers? And that's the first thing on the mind. Everything else about retail today, for the most part, is performing almost at optimal levels. Our clients are really focused on the capital markets, what's the cost of debt, the availability, and what's the value of my property if I'm a seller and or if I'm a buyer. The dislocation that has been in existence where sellers are looking backwards at pricing before the interest rate moves and buyers are looking ahead, assuming that there's going to be more interest rate moves upward and therefore the debt's going to cost more, is that dislocation is shrinking. And there's a few reasons that that's happening, but both sellers and buyers are moving to where that dislocation is reducing, and you're starting to see the beginnings of a normalized transactional environment where we have better clarity and understanding in terms of where certain assets should be trading at and what that value is today. Now, the caveat is there still remains uncertainty and volatility in the markets, given what's going on in the banking system and what the Fed may or may not do in the upcoming meetings for the rest of the year. We are seeing sellers with deal fatigue as well as buyers at the same time are understanding that they aren't going to get these massive discounts because retail overwhelmingly is a well-performing asset class, and therefore the discount isn't there because there's not distress. So the good thing that's going on right now, pretty much across the entire retail spectrum from a retailer perspective, is retailers are performing very well, maybe as good as they've performed in the last 10, 15, 20 years. Doesn't mean that there aren't issues, but overall the sector and most industries within retail are performing very well. Because we have been experiencing as an industry virtually no net new development of any note compared to the time prior to the great financial crisis in 08-09, we have a supply-demand issue. So vacancy has continued to go down, and you may be very well close to one of the lowest levels of vacancy that we've seen in a very long time. And as supply and demand works, you're getting rent increases. You are seeing across the board in most regions, in most forms of retail, you're seeing owners and retailers having to address the fact that rents are going up. And that ranges depending upon location and use, but you're overwhelmingly seeing the ability for rents to move consistently above average prior to COVID. So as we think about the fundamentals being as strong as they are, and now we think about the transactional market, what will and will not sell. The reality is that the uncertainty and the volatility in the capital markets continue to impede both buyers and sellers and other intermediaries to truly get back to a normalized transactional environment. I would anticipate, based upon what clients are telling us as buyers and sellers, that we should see a slow but albeit gradual increase in transactions in the retail environment, both for net lease single tenant retail and multi-tenant retail of most shapes and sizes, maybe with the exclusion of the mall category. So the most active investors today in both net lease, single tenant, and multi-tenant are those investors that are focusing on smaller deal size. The reason is, A, they're either paying all cash or there is better access to debt. Even though that debt costs more today, there's better access to debt for deals that are of a smaller deal size. In net lease retail, that could be somewhere between $3 and $4 million and less. And in unanchored and anchored multi-tenant retail, that could be between $6 and $15 million. As a result, current investors, current buyers are looking at those sectors. That's where the most activity is today, given the environment that we're in.